Howdy there, folks. Welcome into today's video. Tom Lee. Yes, Tom Lee is the one giving a major warning to stock market investors out there. We're going to listen to what he has to say in this little 2-minute clip here about bracing for an air pocket after recent rally. Okay, so Tom Lee's being a little careful and scared. This should be interesting.
Last time, you made an interesting prediction. I want to play that. Here it is.
I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
Since then, the Dow and S&P 500 have hit record highs. I mean, I think we're on track now for 5 days of new records. Are you...
You don't get often where Tom Lee looks too bearish. This is interesting.
Still predicting a pullback, and what would be the catalyst there?
Well, as that clip said, we expected new highs by late January, which was on schedule. And I think this week is going to tell us how much further we go. You know, we were sort of penciling in 5,000, and we could maybe go higher. But from there, yeah, I think an air pocket forms because, one, as you sort of pointed out, investors will get nervous about the Fed and when they start tightening. And parabolic moves, which we've had since October of 2023, usually end in a pretty big retracement. So I do think we continue to be strong, but then after that, I think there's a big air pocket.
So we've talked a lot about the Fed here. Let's talk about...
Okay, before we go further here, do I agree with him or do I disagree with him on a potential downside for the market? Let's just call it in February at some point. And my belief is I 100% agree with him. I do think we're going to have a pullback. I'm not sure it's going to be February or it's going to be March, but I'm pretty confident it's going to be one of those 2 months. And I think there's going to be, regardless, we'll probably head down at some point and have a nice pullback in either February or March is my thinking. And the reason being, and by the way, we could go up further before we get to that pullback, so that's just some food for thought there. But my kind of thinking around that is I think if the Fed doesn't cut rates, or they're not signaling they're going to cut rates in March, a lot of people are going to freak out over that because then they're going to be like, wait a minute, I thought they were cutting, they're not cutting now. When are they going to cut? So that's a dilemma. The second component is even if they do cut, I think it looks bad. I think it looks like, wow, the Fed's really scared of the economy going off the rails here. And usually when the Fed starts cutting, it's not necessarily a good thing for the economy or the stock market. So I think regardless, we're screwed. So I think there's a decent probability we'll have a nice pullback in either February or March. That's just my thinking. But like I said, we could go higher in the meantime before all that. Whoa, okay, that was interesting. All right, guys, so let's keep rolling on here.
So you've got Alphabet and Microsoft tomorrow. On Thursday, you have Amazon and Meta. We've seen these big tech companies really focus on efficiency and where they're spending and where they need to pull back. And it looks like restraining some of the spending where jobs are concerned. What do you expect out of earnings and how might that propel the markets?
Well, this is the biggest week for earnings. I mean, 108 companies report. The FANGs are reporting, both Tuesday and Thursday. And, these companies, I mean, they're big, but they do operate in different spaces. So I think if you have disappointments, let's say you have something disappointing from Apple.
I will be going on live on Twitch on Thursday, by the way, just so you know as well. So it's not just today, it will be Thursday.
I don't think it's going to necessarily weaken the market broadly. It's going to hurt anyone who owns it. But I think for the most part, I think earnings have been delivering. This has been a pretty decent earnings season. And I think it's really confirming earnings this year should be up double digits.
Oh.
What about the jobs report? What are you expecting to come through in that? Because the layoffs, they have been so headline grabbing, but we've seen such a labor squeeze from smaller businesses. It's not clear that they're eager to do layoffs.
The jobs report is getting harder to predict, right? Because the response rates are lower, and there's been a pretty big divergence between the household survey and ADP and the jobs report. So it is a little bit of a crapshoot to see, but it's still important. And I wouldn't want to see a really bad report. I wouldn't want to see negative jobs, but a softening jobs market would be good.
Tom, it's great to see you on this Monday. Thank you for being here.
Thanks.
All right, that's Tom Lee. Last video up here. Global investors are all in the United States, says Goldman's David Kostin.
Has an S&P target of 5,100. Joins us here at Post 9. David Kostin, welcome to you, sir.
Nice to see you.
Nice to see you. You just got back from traveling the world, right? Europe, in Asia. And I'm curious what you're hearing from global investors and what they're excited about.
So, Zara, for the last 30 years, the macro strategy team at Goldman has traveled to Europe and Asia, as you indicated. We were in London, Paris, Zurich, and Frankfurt in the second week of January. We meet with a lot of sovereign wealth funds, investors, institutional investors. And we have an opportunity to exchange views. And then we head off to Asia and we visit clients in Japan, Hong Kong, and Singapore. And so there were sort of a couple of takeaways I thought was interesting this year relative to previous years. First of all, we do a survey, and about half of the portfolio managers are anticipating equity returns on a global basis, somewhere between 0 and 10%, which is pretty consistent with our forecast. We're sort of up 3.5% already this year here in the United States. Now maybe another 3.5% or so left to go. Pretty modest upside, as you indicated, Sarah, to maybe 5,100. That's pretty consistent. About half the portfolio managers were in that camp. Another third were in more bullish, and they're somewhere between 10 and 20% type of returns. That's kind of return expectations. They were all in on the United States, and that's unusual because typically there's a home region bias. You go to Asia, and there's sort of a bias in favor of the companies there. It's sort of understandable. They know them best. But that was not the case. Both in Europe and in Asia, most of the fund managers were inclined towards seeing the U.S. as the best opportunity set. And Japan, Carl, was one that they could have ranked number two kind of across the world that we saw. And kind of way down third, considerably down was China. A lot of concerns around China expressed both in the region in Asia as well as in the European investor community. Yeah. And then Europe was sort of at the tail end. So that's sort of the geographic split. And then within the different
China's
sectors,
going up from here, though,
people were more inclined towards technology. Not a shock there in terms of looking back in performance last year. Number two is healthcare. That was the sort of second most interesting opportunity set. And the last item, Sarah, is your favorite, Magnificent Seven versus the 493. There was a big debate. And it was basically, Carl, kind of 50-50 split, maybe a slight lean towards the Big Seven, but not.
Look at Boeing trying to cling on to 200.
Contrast with our view. My view is that I lean sort of a little bit in the other direction, which is a broadening of the market, the other 493. And sort of given a choice, actually, I'll take the 2000, not the 7, not the 493. We'll take the Russell 2000 in small caps. And that's sort of the lay of the land, having just traveled around the world in 2 weeks.
Has any of the recent action...
Hey, listen. So everybody forgets the Russell Wilson, baby. That baby's still going to roll this year. Tom Lee, 50% plus. Okay, I'm not that bullish, but I'm still very bullish on the Russell as well.
Russell made you question your call for small caps to do better, at least?
Well, the view within Goldman Economics is that the economy is actually growing pretty strongly, very strongly. And as a consequence of that, that actually benefits the more domestic orientation here in the United States of the small cap stocks. They have 30% of their borrowings are floating rate. And so the idea of the Fed cutting over the course of this year will have a one-to-one benefit for a lot of these companies where they have floating rate on the balance sheet, in contrast with some of the larger companies where there is actually pretty stable balance, strong balance sheets, but their debt isn't going to mature until past 2030 in most cases, and there's not that much is floating rate.
And that fits with Goldman 100%. In the March camp.
And that's correct. That's sort of the idea there. And some of the net interest income for a lot of companies with strong cash, strong cash positions should diminish over time as the Fed is cutting kind of 5 times, which is the baseline for the Goldman view. So that's the thought process.
I don't know about that. We'll see. Okay. Next up here, Federal Reserve former Vice Chairman Roger Ferguson.
Vice Chairman, former TIAA President and CEO, and a CNBC contributor as well. He's got a lot of things on his resume. Roger, it's great to see you. Do you have a new view?
Nice to see you, Andrew.
You got a new view, given all the numbers that we've seen thus far? Is this pushing things out? How quickly is Jay Powell really going to be lowering interest rates in your world?
In my world, it's still the second half of the year. And for me, that's not a new view. I think what we've seen is an economy that is still strong. The last GDP print, I think, surprised a little bit. The good news is the last PCE print suggested that the disinflation process is underway. But there are some concerns that a few people might have. Some of the turmoil in the Mideast might lead to pick up slightly in goods inflation, and the service sector still is a little hot. So I think second half of the year still is my bet at this stage, and I think the market is starting to come at least in that direction.
And is that
do I agree with him? And the answer to that is yes, I do agree with him. I'm expecting second half more likely than first half. They'll put it like that.
3-cut situation, a 2-cut situation, a 1-cut situation? What are you thinking?
It's also about the
I'm thinking may well be 3. The issue obviously is, fortunately, inflation looks like it is moving in the right direction. They have no need to stay in restrictive territory in the real rate, the nominal rate minus inflation. And so, I think squeezing 3 in the second part of the year is still my base case. Certainly not more than that, possibly a little less if things slow down. Okay. So that's where my head is right now, and that's not a dramatic change for me.
Okay, you can answer this question with more authority than practically anybody we've had on the broadcast recently. So I want you to end this debate for us, if you could, or maybe we'll just continue it. You know where I'm going with this? So we have a lot of people who come on who say,
I'll let you go.
Who say, you know what? It's very difficult for the Fed to start lowering interest rates in a presidential election year as you get closer to the election itself. And that weighs on everybody. It actually is part of the conversation. And therefore, they may not do these things, or they're going to want to do these things before that. Take us, you had the job. Take us inside the room. Does the presidential election become part of the actual discussion itself?
I've never been in the room when the presidential election was part of the discussion itself. I can't speak to what's in everyone's mind, obviously. But think about it. If they cut early and it proves to be the wrong thing to do, they'll find themselves raising rates in an election. If they delay, they find themselves losing the possibility of getting, the soft landing that looks like it's within grasp. At the end of the day, following the economics is the only thing that matters, because that's how you get to the best outcome. And if the politics get in the way of that, then someone's going to look bad. And so I think the logic of the case has got to be follow the economics, carry out your plan, because that's the only way to actually stay out of harm's way.
Yeah, so there's a thought process, okay, to go to the political side. There's a thought process that, okay, T-Man isn't in love, obviously, with Powell. And I believe he's even made comments in the past that he would potentially fire Powell. So there's a belief that maybe Powell wants B-Man and not T-Man to be in office again, right? And for another 4 years. So the thought process is they cut to try to make the economy look better going into the election, so then B-Man's president again, right? So that could potentially be something positive in the short term there if you want that. But here's the problem. Let's say they cut, too much too fast, inflation comes back, they got to come in with rates again. All of a sudden you have a super deep recession in 25 or 26 or something like that, or 27 even, right? Well, then you just killed the next election in terms of Dems getting in, right? And you're also going to affect smaller elections outside of the presidential election as well. And so that could create a whole dilemma for you, a massive dilemma. So, that's kind of like, maybe you could have a little short-term gain, but then you might get long-term pain, right? The Fed's got to, at the end of the day, make the best decision that they feel, regardless of who you want in office or not in office, right? And so, that's, you got to factor that in.
Roger, Nick Timmeros at the Wall Street Journal had an article that hit yesterday that raised a lot of questions about what we might anticipate the language change could potentially be coming out of this meeting this week. That while he doesn't think they're going to be cutting rates this week because the economy's been pretty steadily growing, it does raise this question about whether they're going to ditch the whole idea about the most likely scenario being that rates would rise from here. You think that is a reasonable way of looking at things, kind of easing your way out of that to open up the door for potential interest rate cuts?
I think they're going to have to acknowledge that inflation is coming down closer and closer to the 2% target. Consequently, that gives them some room to move rates lower. So they're, I think, going to try to guide as softly as they can towards the second half of the year cutting. They certainly want to keep in place at least, the 50-50 in March and try not to, raise expectations of an earlier cut. So it's going to be walking a bit of a fine line by admitting that, yes,
yeah, I was going to say it's hard to not raise expectations
cutting.
of the March really happening without signaling when you're signaling something like this.
I think that's right. So recognize what they're going to. I think they're going to try to hint at a delay, but I think in the conversation, Chair Powell is going to talk about the SEP and other things that seem to put that delay, that cut towards the second half of the year. But it's going to be a tightrope for him.
Yeah, fair play by Roger Ferguson there, okay? All right, last one up here. Adrian Denny. The Fed should hold off on any easing at all. Okay.
debating what the Fed's going to do. We've also been debating how some of these earnings are going to turn out, though I think people are a little more optimistic than they had been 2 weeks ago. Where are you?
Well, I've been consistently optimistic, actually, about this bull market that started October 27th of 2022. So far, so good. I think we're getting a little bit stretched. Need to have some consolidation. But earnings, I think, are going to be fine, especially for the quality names that Mike just went through. And at the same time, we've got some other issues that are becoming maybe more relevant, and that's the ongoing conflict in the Middle East. And of course, the Fed has to deal with these issues just the way investors do.
So he says, earnings for a lot of the big guys should be just fine. My opinion is, I don't think just fine. I think really, really good. If we're talking about most of the Magnificent Seven, outside of maybe Tesla and Apple, I think phenomenal. I did a full video on the main channel yesterday that went into my in-depth thoughts on Meta's earnings coming up, Amazon, how much I think they'll beat or miss on, and all those sorts of things. So if you didn't get to check that out yesterday on the main channel, definitely check out that video. You'll enjoy it.
Your optimism, layer on the Middle East, it seems like the market is taking it all in stride. Should it be?
Yeah, I think that's absolutely correct. I keep watching the price of oil, and it has come up somewhat. But there must be a tremendous amount of oil out there available for all sorts of different channels. At the same time, it's important to realize that this notion that the U.S. had to have a recession to bring inflation down turns out to be incorrect. What really happened is China has had a recession, a property-led recession, and Europe's been in a recession, so the demand for oil has been weak. And so that's offset some of these Middle Eastern concerns.
When you think about what the Fed is going to do, how important is your optimistic take to the idea that the Fed is going to cut potentially in March? Is March too early?
Yeah, I think I'm a contrarian on this issue. The markets have been expecting 4, 5, 6, maybe 7 cuts this year, and sooner rather than later. I think the markets have backed off a bit on that. But I actually would like the Fed to hold off easing at all. I think the Fed has actually not only tightened, but actually normalized. Interest rates are back to where they were before the great financial crisis. Investors are finally getting an appropriate return in the money markets and in the bond market. And the economy has demonstrated that it's resilient and it can live with them. So I'd like to see, you discussed capital markets in a previous report here. I'd like to see the capital markets work more efficiently and let the bond market determine where capital should go.
So you think you just leave them as is, and the market will still go up at this point?
Well, I think if you leave them as is, and it's clear that one of the reasons for that is because the economy is doing well and earnings are coming in strong, then I think it's a good trade-off. But I don't think there's any rush for the Fed to ease right away here. They got the risk of the Middle East creating a 1970s scenario, two energy shocks. Right. And then if they ease and become too dovish, they'll get a 1990 scenario, which is irrational exuberance. So I think the smartest course for them to avoid these kind of risks on the tail risks is to, in fact, do nothing.
I'm loath to ask.
I like that as well. And my thought process is, hey, if you see unemployment really start to tick up in any meaningful way, okay, start your cutting cycle, right? Because then it's like, okay, we could be going into recession, so let's get ready to go here, right? But I would, if I was a Fed, you kind of want to try to hold off as long as you possibly can in regards to that, right? Because one, you don't want to spike inflation again and then have to come in when the economy is in a much weaker state at that point in time with more, rate hikes. That would be devastating, because then you're talking about a way deeper, darker recession at that point in time, right? So, make sure inflation is done, right? If you can wait that long, why not? Why not at that point, right? And as somebody that, if you have money in a savings account right now or treasuries, it's phenomenal finally be able to get a decent return. I mean, up until the last really 15 years, throughout history, it was never a normal thing to be able to get like a 0% or 1% or 2% return on, money. And now we can actually get 4 to 5% between savings account and treasuries. That's magical. We have never really seen that, at least in my adult lifetime. My adult lifetime started in 2008, right? I was about 18 years old, so my adult lifetime started. I mean, my entire adult lifetime until really the past year, you weren't ever able to get anything on some cash laying around in either treasuries or savings account. It's beautiful to actually finally have some of that, right? And so, I'm kind of with Ed Yardeni. And by the way, like he puts there, we're kind of just back to normal, like normally where we should be. It's not normal to have interest rates at 1% or under 1%. That's not normal at all. That usually means you're in, harder economic times.
It's just a cliche of a question at this point, but are the Magnificent Seven still magnificent?
Some yes, some not so much. It's starting to be a little bit of a more specific story for each individual stock. Tesla has obviously some issues right now, but maybe it's not 7 anymore.
So what is it, and what would you buy and what wouldn't you touch?
Ooh.
Well, we did see a nice rebound since late October of last year in the small cap and mid cap stocks, which made a great deal of sense to me because these are really cheap stocks compared to the S&P 500. And there are lots of good small and mid-sized companies that should do well in an environment where for the third year in a row, we're not going to have a recession as has been widely anticipated. So I think that's a good area to be. I would stick with technology. I would stick with financials. I think energy has to be overweighted as a hedge against the Middle East craziness.
Yeah, Google's okay. Microsoft's okay. Meta, Amazon are buys. Nvidia, actually a buy, surprisingly enough. So yeah, there's certainly some opportunities there. And then in small caps, we know there's a lot of opportunities out there. Okay, appreciate y'all joining me as always. Thanks so much for being here. If you need help understanding valuations, if you're getting ripped off when you buy a stock, if you're getting a great deal when you buy a stock, if you need help understanding income statements, balance sheets, cash flows, anything like that, I have courses inside my private stock group. If you want access to those, pin comment down there, apply to join us in there, and get your game up. All right, much love and have a great day.